Welcome to the deep dive. The U.S. economy, it feels like it's kind of holding its breath right now, doesn't it?
It really does. There's a definite sense of uncertainty.
Yeah, and we've got this fascinating set of data in front of us, mostly from this piece, U.S. economy at a crossroads. And, well, it paints a picture that's way more complex than that soft landing talk from a little while back.
Right. That narrative has shifted quite a bit. Now it feels more like, what, an economic wobble?
Exactly, an economic wobble.
Yeah.
So our mission today really is to get under the hood of that wobble. We want to figure out the key things making it feel unsteady.
And how they might connect, maybe in surprising ways.
Precisely, aiming for some of those aha moments you appreciate. So let's jump in.
Absolutely. The shift, like you said, has been really pronounced. What immediately jumps out is this kind of tension. You've got slowing growth on one side.
Right.
And inflation that's, well, maybe moderating a bit. The Atlanta Fed's GDP Nowcast, that real-time snapshot,
It's showing.
it's actually showing a contraction right now, minus 0.3% quarter over quarter. That's a pretty clear sign that growth is losing altitude, as the source puts it.
Okay, wow, minus 0.3. So definitely cooling down on the growth front. But then, like you said, inflation, the signals are a bit mixed, maybe?
They are a bit confusing, yeah. Core CPI in March, it did dip below 3%.
Okay, that sounds positive.
And the main number, the headline rate, came in at 2.4%. And here's something interesting. The monthly change, it was actually negative 0.1%.
Negative, really?
Yeah, first time we've seen it below that 2.5% mark since, gosh, 2021. So you see headlines like, inflation finally cooling.
Okay, so the big question then is, is this slowdown because inflation is cooling? Or are there other things pushing growth down?
That's the million-dollar question, isn't it? That's the puzzle. While, any cooling is welcome,
Of course.
we really need to dig into why growth is slowing. And this is where policy and maybe surprisingly politics start to come into play more sharply.
Okay, policy and politics. Let's unpack that. This idea of policy credibility threatened. The analysis we have points right at former President Trump's comments about Fed Chair Powell.
Yeah, his recent public comments. And how they seem to inject a lot of volatility into the markets.
It feels like more than just the usual political noise, doesn't it?
It certainly does seem that way. I mean, the market's reaction was really fast and quite revealing. The dollar index.
The measure of the dollar's strength.
Exactly. It plunged to a 3-year low, 97.9, just after those remarks.
Wow. And at the same time, gold.
Gold went through the roof. COMEX gold spiked to $3,392 an ounce. And in India, MCX gold actually broke 97,000 per 10 grams.
Huge moves. What does that tell us? People running for safety?
Sort of, yeah.
Yeah.
It often signals investors looking for safer assets, maybe questioning the stability of, well, the established order, in this case, the U.S. dollar. It really shows how fragile confidence can be around the Fed's independence.
So the market thinks political interference could mess up monetary policy.
That seems to be the implication, yeah. It suggests this deep belief that political meddling could lead to, let's say, less than ideal policy. And investors, they just immediately adjusted their risk calculations.
That's a really clear way to put it. And it wasn't just currencies and gold, was it? What about bonds? Treasury yields?
Right. The 10-year Treasury yield, the benchmark, it jumped up to 4.40% initially. That's a big move, fast.
Very fast. Does it stay there?
It did settle down a bit later, but the analysis talks about this political risk premium, basically an extra cost baked into long-term bond yields,
How much extra?
around 20 basis points, just because of those comments.
20 basis points. That's not insignificant. That's a real cost of borrowing added just because of perceived political risk.
Exactly. And, this really hits home why central bank independence matters, as the source says. The research is pretty clear on this.
What does it show?
Well, central banks that aren't protected from politics, they tend to run inflation rates about 2 to 3% higher.
2 to 3% higher. That's substantial.
It is. And crucially, there's no growth benefit that comes with it. So independence is really framed as the anchor of macro financial stability.
The anchor. Yeah, it feels like the markets are shouting, just let the Fed do its job.
Pretty much. And the historical examples mentioned, the U.S. in the 70s, Argentina, they really drive home what can happen.
What are the consequences?
Typically, you see higher borrowing costs for everybody, those really damaging boom-bust cycles, and ultimately lower real wages for people. It's not a good picture.
No, definitely not. Okay, let's shift gears a bit. There's an area that seems, well, almost contradictory to the slowing growth story, retail sales.
Yeah, that was surprising. March saw a really strong jump, 1.4% month over month.
1.4%, that's quite healthy.
It is. And even core sales, taking out the volatile stuff like cars and gas, they were up a solid 0.4%.
Okay. And you mentioned cars. Was there something specific happening there?
There was. Auto sales surged,
Yeah.
up 5.3%. And there's this interesting potential connection.
Ah, the pull forward effect. I saw that mentioned.
Exactly. The idea is maybe consumers are rushing big purchases, like cars.
Before potential tariffs hit.
Precisely. There's talk of a possible 25% tariff on imported cars.
25%. Okay, so this jump in retail sales might just be temporary, a kind of pre-tariff rush.
That's the interpretation, yeah. A temporary blip. The tariff timeline in the source seems key here.
When did that start?
The USTR filings were on April 3rd, so it seems likely we're in that pull-forward spending phase right now, people trying to beat the price hikes.
Makes sense. But what happens after, if the tariffs actually go into effect?
That's the big worry. The analysis flags a potential supply shock and inflation pressure.
So more inflation, and maybe less stuff available.
Potentially, yes. So you get the short-term boost in spending, maybe, followed by longer-term issues with both availability and cost.
Right, a temporary sugar rush, then maybe a headache. Got it.
Yeah.
Okay, what about the labor market? That also seems mixed.
Very much mixed signals. Initial jobless claims for the week ending April 13th were 215,000.
Which sounds, okay, not terrible.
On its own, yeah, it doesn't scream downturn. But the unemployment rate did tick up in March to 4.2%.
Okay, a slight increase.
And maybe more concerning, the number of people continuing to claim unemployment benefits hit 1.885 million. That's the highest it's been since 2022.
So maybe not mass layoffs, but people who are unemployed are staying unemployed longer.
That's what it suggests, yeah.
Yeah.
Finding a new job seems to be getting harder.
Feels like we're in a kind of limbo with the job market then.
It does. And, this sets up a really interesting situation with the Fed. There's this gap opening up.
A gap between what the Fed says and what the market expects.
Exactly. The Fed's current rate target is 4.25% to 4.50%. They held it steady in March.
Right.
And their own projections, the dots, suggested maybe 50 basis points of cuts later this year. 2 quarter-point cuts.
Okay, so the Fed's thinking 2 cuts in 2024. What's the market pricing in?
That's something more like 125 basis points of cuts.
Wow, that's 5 cuts versus 2. That's a big difference.
It's a substantial disagreement, yeah. It shows a real disconnect between the central bank's stated intentions and what investors think is actually going to happen, or maybe what needs to happen.
Which naturally leads us to these market warning signs, the analysis flags. It sounds like the bond market is getting edgy.
Definitely showing some signs of unease. We're seeing an elevated term premium.
Remind us what that is again.
It's basically the extra yield investors' demand for holding longer-term bonds instead of just rolling over short-term ones. It compensates for uncertainty way out in the future.
So a higher premium means more uncertainty.
Generally, yes. We're also seeing widening swap spreads.
Okay, what does that mean?
It's a bit technical, but widening swap spreads can be a classic sign of maybe some loss of credibility or increased risk perception within the financial plumbing, like worries about counterparty risk.
Got it. Increased risk perception.
And the yield curve.
It's getting steeper. Specifically, the gap between 5-year and 30-year Treasury yields is widening. That can sometimes signal worries about future inflation picking up again. So uncertainty, risk perception, inflation, fears, all baked into the bond market now. And are investors acting on this? Are they pulling money out?
It looks like it. The analysis points to a pretty significant bond fund exodus. Almost $20 billion flowed out of global bond funds in just 1 week recently.
It's $20 billion globally.
Yeah. And notably, $5.2 billion came out of high yield or junk bond funds specifically. That suggests risk aversion is climbing.
And what about stocks? Did equities react too?
They did. We saw markets tumble. On April 21st, the S&P 500 was down over 2%, NASDAQ down even more, about 2.5%.
Okay, so selling across the board. Did valuations change much?
Yeah, the forward PE ratio for the S&P 500, how expensive stocks look based on future earnings, it dropped back to 17.9. So a bit less frothy, maybe.
And just to circle back quickly to those Trump comments about Powell, you mentioned the dollar and gold, but what about the bond market specifics?
Right. The immediate reaction there was also quite stark. That term premium we talked about, it widened by 12 basis points in just 2 hours after the comments came out.
12 basis points in 2 hours.
Yeah. The dollar dropped 0.8% almost instantly. Gold jumped $60 an ounce. It's just a very clear, rapid market vote on that perceived risk to the Fed's independence.
Undeniable link there. So putting all this together, what are the biggest risks the analysis sees over the next year or so?
They identify these top 4 risks for the next 12 months. These feel pretty concrete given everything we've discussed.
Okay, what's number one?
Number 1 is policy error. Specifically, the scenario where Chair Powell is actually removed, or the Fed's independence is seriously compromised somehow.
And the fear there is.
Stagflation, that nasty mix of high inflation and stagnant or even negative growth.
Right, the worst of both worlds. What's the second risk?
A debt service squeeze. Basically, the cost of servicing the U.S. national debt. Projections show interest payments possibly exceeding $1.3 trillion.
Trillion, with a T.
Yep. And the worry is fiscal crowd out. The government borrowing so much, it pushes up interest rates for everyone else and hinders private investment.
Makes sense. Risk number 3.
The tariff-induced supply shock. If those tariffs on cars and electronics actually happen, it could really push up core goods prices, maybe drive core CPI back over 3%, adding to inflation woes.
Okay, tariffs again. And the fourth risk.
Financial fragility. This centers on worries about commercial real estate, rising delinquencies there, and maybe high-yield bond spreads widening further, potentially triggering a broader credit crunch, like banks pulling back lending.
Okay, those are all pretty serious potential headwinds. Does the analysis try to guess which way things might actually go? Maybe some scenarios?
It does. It lays out 3 distinct scenarios for the end of next year, Q4 2025, each with a probability.
Okay, let's hear them. What's the most likely one? The base case.
The base scenario has a 55% probability. It's kind of a muddle-through picture. GDP growth is positive but slow, maybe plus 0.8%.
And inflation?
Inflation stays a bit sticky, around 2.6%. The 10-year Treasury yield is maybe 3.9%, and the S&P 500 at 4,700. So not a disaster, but not great either.
Okay, sort of sluggish growth, persistent inflation. What's the bad scenario? The downside?
The downside scenario gets a 30% probability. This looks much more like a recession. GDP actually contracts, -1.2%.
Ouch. And inflation? Does it go down in a recession?
Not in this scenario. Inflation actually jumps to 4.1%. So stagflationary again.
Wow. In bonds and stocks.
The 10-year yield spikes to 5.2%, and the S&P 500 falls sharply, maybe to 3,800. A really tough environment.
Definitely one to hope we avoid. Is there an upside? A better possibility?
There is an upside scenario, but it's seen as the least likely, only a 15% probability right now.
What does that look like?
That's more like the soft landing, maybe. GDP growth is stronger, plus 2.0%. Inflation behaves, coming down to 2.1%.
Nice. And markets?
Treasury yields fall to 3.3%, and the S&P 500 climbs higher, maybe 5 of 300. Kind of a Goldilocks outcome, but yeah, lowest probability currently.
Really helpful to see those laid out, even with the probabilities. Now, the analysis does something interesting. It looks at global impacts, using India as a case study. How does this U.S. wobble affect other places?
Yeah, this really shows how interconnected everything is. Paradoxically, the analysis suggests that if the Fed's credibility does take a hit, it could actually support Indian government bonds, or GSECs.
How does that work? That seems counterintuitive.
Well, the yield on the 10-year Indian government bond actually eased a bit, down to 6.45%, even while U.S. yields were rising. The thinking is it widens the real yield differential.
Real yield meaning adjusted for inflation.
Exactly. So if U.S. inflation expectations are rising faster due to credibility concerns, the real return on U.S. bonds looks worse, making Indian bonds, with their relatively stable inflation outlook, look more attractive by comparison.
Huh. So U.S. instability could, in a weird way, benefit Indian debt investors.
In that specific context, potentially yes. We also saw the Indian rupee strengthen against the dollar, hitting 85.13. That's partly the weak dollar, partly the Reserve Bank of India managing things.
And are foreign investors putting money into India?
It's a mixed bag. The analysis calls it selective risk-on positioning. There were inflows into Indian stocks, but actually small outflows from bonds in the week they looked at. So investors are still being cautious, picking their spots.
Okay, nuanced flows. What's the outlook for Indian bond yields going forward then?
The thinking is if U.S. yields stay high, say above 4.5%, you might see more money rotate into those Indian bonds easily accessible to foreigners, the FR bonds.
And that would do what to yields?
It could actually cap Indian government bond yields, maybe keep them around 6.60% because of the increased demand.
Interesting. And what about the Indian stock market? Can it shrug off U.S. problems?
Well, the Nifty index had a strong rally on April 11th, and the analysis highlights that as showing some decoupling potential. Maybe India can be a bit more resilient this time.
But surely some parts of the Indian economy are still vulnerable.
Oh, absolutely. The analysis points to the vulnerable sectors, anything heavily reliant on exports, particularly to the U.S., so
Mm.
IP services, metals. They could feel the pinch if U.S. demand slows,
Makes sense. Which sectors are seen as more resilient?
mostly domestic-focused ones, banks, utilities, things less tied directly to U.S. consumer spending or business investment.
So, if you were investing in India, how might you position yourself given this outlook?
The analysis suggests a few strategies. For momentum investors, maybe underweighting those U.S.-exposed tech stocks. For value investors, maybe looking at state-owned banks, which could benefit from interest rate differentials, the carry trade.
Carry trade. Okay. Anything else?
For a low volatility approach, they mention gold ETFs, but suggest capping it at maybe 15% of a portfolio just to help manage risk in a potential downturn.
Gold again. And there was this interesting phrase, India as a central bank haven.
Yeah, that's a fascinating idea. If global investors start really prioritizing central bank credibility and independence, maybe capital flows towards markets like India, where the central bank is perceived as more independent.
A potential safe harbor for policy credibility, but as you said, still vulnerable on the export side in the near term.
Exactly. It's not totally insulated. And just bringing it back to that core issue, independence, the analysis really hammers home the cost of political interference.
What's the key statistic there?
It highlights research showing that for every 10 percentage point drop in a central bank's independence score, average inflation tends to be zero point 0.7 percentage points higher,
Zero point 0.7 points higher inflation.
with no offsetting gain in economic growth. It really makes the case for that independence premium. It's not just academic. It has real economic consequences that markets watch closely.
Absolutely. And the big worry threading through all this is that stagflation risk.
Right. Rising inflation from political pressure, slowing growth from tariffs and uncertainty, and market stress from funding issues and volatility. It's a dangerous combination.
And the key thing to watch, according to the analysis,
The Fed chair watch. Any formal move, any serious attempt to unseat Chair Powell, that's flagged as a potential major sell signal for long bonds and cyclical stocks. Markets would likely react very negatively.
So watching the political winds around the Fed is absolutely critical right now. Given all this uncertainty, what are the final recommendations on strategy?
Well, for portfolios, the advice is diversification, using factor-balanced approaches like equal weight baskets and rebalancing regularly to handle the likely volatility.
Standard advice, but probably more important than ever right now. What about businesses, exporters?
For them, there's a currency hedging recommendation. Since the rupee is relatively strong now, consider using options like put spreads to lock in exchange rates and protect future revenues from a potential weakening rupee later.
Okay, proactive risk management on the currency front. And the final indicator mentioned, gold.
Yeah, the gold rush continues. Gold pushing past $3,400 an ounce is seen as just another sign of really deep market concerns about policy, inflation, and stability.
A powerful signal. Okay, so wrapping up this deep dive, it really feels like the U.S. economy is navigating some tricky currents with potentially significant waves spreading globally, like we saw with the India example.
Definitely a complex picture.
So a few key takeaways for you, the listener. First, absolutely keep a close eye on any news, any developments surrounding the Federal Reserve Chair and the Fed's independence. That seems like a critical signal.
Couldn't agree more.
Second, diversification in your investments. It sounds basic, but managing volatility seems key right now. Equal weight approaches, rebalancing, consider those tools.
Yes, managing risk is paramount.
And third, if you're involved in exporting, especially with exposure to the U.S., think seriously about those currency hedging strategies. Protect your downside.
Sound advice.
And maybe one final thought to leave you with, building on our discussion. Given everything we've heard today about the history, the data linking central bank independence to better economic outcomes,
Yeah.
what long-term, maybe structural changes could actually help insulate the U.S. economy, or any economy really, from these kinds of political pressures on monetary policy? It's a big question, maybe the question for long-term stability.
That is a really profound question to think about. How do you build resilience into the system itself? Lots to mull over there.
Definitely something to ponder. Thanks for joining us for this deep dive. We hope you'll continue exploring these interconnected issues. Until next time.